In 2025, while most investors were glued to the stock market's solid gains, one industrial metal quietly delivered a stunning performance that caught even seasoned analysts off guard. Copper climbed more than 40%, nearly tripling the S&P 500's respectable gains for the year. And here's the thing, this wasn't some speculative frenzy or a short-term squeeze. The market was looking ahead and pricing in a future where supply simply can't keep up with demand. This is the inside story of how copper surged to its best year in over a decade, and why what's happening in 2026 could push it to even more historic highs. For decades, Wall Street has had a nickname for copper. They call it Dr. Copper, the metal with a PhD in economics. The reason is simple. Because copper is used in literally everything, from buildings and factories to the power grid that runs our lives, its price has long been seen as a reliable barometer of global economic health. When Dr. Copper is rising, the economy is humming. When it falls, a slowdown is often just around the corner. But in 2025, something shifted. Copper didn't just signal economic health, it became one of the most explosive investment stories of the year. The metal, which started 2025 trading under $9,000 per ton, relentlessly climbed throughout the year, blowing past expectations and hitting a record high of nearly $13,000 per ton by year's end. This rally was driven by a fundamental repricing, a perfect storm of roaring future demand and the looming threat of a severe supply squeeze. So what's really driving this surge? The answer lies in two of the most powerful technological revolutions of our time. The information I'm sharing today is for educational purposes only and shouldn't be considered financial advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Back to copper now. The first half of the copper story is a radical shift in what's driving demand. For a century, copper demand was tied to building cities and making traditional goods. Now, it's being driven by building the future. The first and newest engine is the artificial intelligence revolution. The AI arms race has kicked off a colossal build-out of data centers, chips, and power infrastructure. These data centers are the factories of the 21st century, and they're incredibly power-hungry. That hunger for power translates directly into a hunger for copper. Every megawatt of new data center capacity requires vast amounts of copper for power delivery, cabling, and cooling systems. According to a Department of Energy report released in late 2024, data centers consumed about 4.4% of the country's total electricity in 2023. The projection is that this figure could jump to anywhere from 6.7 to 12% by 2028. Think about that for a second. This new structural source of demand was barely a rounding error a few years ago. Now, it's a primary driver of the market. The second engine is the global transition to green energy. This isn't a new story, but its scale is accelerating like never before. Electric vehicles, for instance, use about 4 times more copper than a conventional car. Every EV needs the metal for its battery, motor, and internal wiring. As global EV production continues to climb, this alone provides a massive tailwind for copper demand. But it goes way beyond cars. Renewable energy infrastructure, like wind turbines and solar panels, is also a huge consumer of copper. And modernizing the world's power grids to handle this new decentralized energy system is perhaps the biggest piece of the puzzle, requiring immense investment and an incredible amount of copper wiring to connect it all. These two forces, AI and electrification, are creating a demand wave that's only getting started. But skyrocketing demand is only half of the equation. The other, and arguably more critical reason for copper's price explosion, is a deepening long-term supply crisis. Put simply, the world is struggling to find and produce enough copper to meet this new wave of demand. Unlike manufacturing a smartphone, You can't just decide to make more copper. It has to be found and dug out of the ground. And here's the problem. The world is running out of high-quality, easy-to-access copper deposits. The average grade of copper ore has been declining for years, meaning miners have to process more and more rock to get the same amount of metal. On top of that, bringing a new copper mine online is an incredibly slow and expensive process. Research from S&P Global shows it now takes an average of nearly 18 years to go from the discovery of a deposit to actual production. Think about that. 18 years. These projects face immense hurdles, from tough environmental regulations and community opposition to geopolitical instability in key mining regions. This has created what analysts are calling a coming structural deficit, a persistent gap between what the world needs and what miners can produce. While some analysts noted a market surplus in 2025, many point to a market that's quickly tightening. For example, JP Morgan is forecasting a global refined copper deficit in 2026. This isn't a cyclical downturn. It's a fundamental bottleneck that threatens to slow down the entire green energy and AI revolution. It's this growing fear of a long-term squeeze that has transformed copper from a simple industrial metal into a strategic asset. Now, copper wasn't the only metal that had a phenomenal year. Silver also saw an incredible price surge, with annual gains approaching 150% in 2025. This has led a lot of investors to ask, which metal is the better bet? While both metals are benefiting from industrial demand, they play very different roles. Silver is often called poor man's gold because it has a dual identity. It's both an industrial metal and a monetary asset people turn to during times of financial uncertainty. Its incredible conductivity, the best of any element, makes it essential for high-tech applications like solar panels and microchips. But its higher cost often limits its use. Copper, on the other hand, is a pure-play industrial workhorse. It's the second most conductive metal, but its true advantage lies in its cost-effectiveness and abundance, which allow it to be deployed on a massive scale. If you need to wire a data center, build a power grid, or manufacture 1 million electric vehicles, copper is really the only economically viable choice. Think of it this way. If silver is a high-tech scalpel used for precision tasks, copper is the industrial sledgehammer building the world's new infrastructure. And here's something most people don't know. Around 70% of the silver supply is actually a byproduct of mining for other metals, including copper. Its fate is partially tied to the production of its less glamorous cousin. If you're finding this helpful and want to stay ahead of the big market shifts, do me a favor and hit that subscribe button. The insights we're covering here could make a real difference in how you think about your portfolio. After a historic run, the big question is, what's next for copper in 2026? The outlook is what you might call a classic bull versus bear debate. It's a finely balanced market. The bull case remains powerful. The structural demand from AI and electrification isn't going away. In fact, it's likely to accelerate. Supply remains extremely tight, and new mine production is struggling to keep up. This has led several major banks to forecast that copper prices will remain elevated. JP Morgan, for instance, has projected prices could hit $12,500 per ton in the second quarter of 2026, while Citi sees a bull case where prices could approach $15,000 per ton. However, there are significant risks to consider. Analysts at firms like Goldman Sachs argue that while the long-term story is strong, the market may see a small surplus in 2026, keeping prices in a more modest $10,000 to $11,000 range. The biggest wildcard is the health of the global economy, particularly in China, which consumes more than half of the world's copper. Any significant economic slowdown there could dent demand, and after such a rapid price run-up, the market is also vulnerable to substitution, where high prices push manufacturers to look for cheaper alternatives like aluminum. It's a classic tug-of-war between today's macro risks and tomorrow's structural promise. For investors looking to get some exposure to this trend, there are a few ways to approach it. The most direct way is through the futures market, but be warned, this is a high-risk approach that's really best suited for experienced traders. A more accessible route for most of us is through equities, buying shares in copper mining companies. Large, established producers can offer stable exposure, while smaller junior miners provide higher risk, higher reward potential as they explore for new deposits. Finally, for those who want diversification, there are copper-focused exchange-traded funds. These funds hold a basket of different mining stocks or track copper futures prices, and they can be a simpler way to bet on the overall trend without having to pick individual winners. As with any commodity, it's important to remember that copper is cyclical and can be volatile. Most financial advisors recommend limiting exposure to a small slice of a diversified portfolio, typically in the 3 to 5% range, just to manage that risk. The story of copper in 2025 was a massive wake-up call. It was a clear signal that a major shift is underway in the global economy, a pivot from a world powered purely by software and data to one that also desperately needs hard assets and raw materials. Copper's stunning outperformance wasn't a fluke. It was the result of powerful long-term structural forces that are just getting started. The twin engines of artificial intelligence and the green energy transition are creating a demand wave that the world's mining industry is struggling to prepare for. While the path forward in 2026 may be choppy, the underlying thesis is solid. Dr. Copper has spoken, and its diagnosis is clear. The world is electrifying at a pace we've never seen before, and the metal that makes it all possible is facing a long-term supply crunch. So the final question is for you. Do you think Dr. Copper is signaling the start of a new commodity supercycle, or is this incredible rally running on fumes? Let me know what you think in the comments below.